Hello everyone and welcome to another video of this course. In this lesson, we'll be learning about revenue recognition in oil and gas. And under that, we will look at production sharing contracts, joint venture accounting, and the benefits of joint venture accounting. Now, let us look at what is revenue recognition in oil and gas. Revenue recognition in the oil and gas industry is a complex process governed by IFRS 15, and that is the International Financial Reporting Standards. It involves identifying contracts, performance obligations, determining transaction prices, allocating prices, and recognizing revenue when performance obligations are met. This process can be further influenced by factors like production sharing agreements, joint ventures, and royalty payments. So, let's look at contract identification and performance obligations. The first step is to identify the contracts, which can include exploration and production contracts, sales contracts, or service contracts. Then the company needs to identify the performance obligations within each contract, such as delivering oil and gas, conducting exploration, or providing related services. Transaction price determination and allocation. The agreed upon price per barrel is the transaction price, which can be adjusted based on marketing indices or other pricing mechanisms. This transaction price must then be allocated to each separate performance obligation based on their relative standalone selling prices. Now, let us look at production sharing contracts. A production sharing contract, also known as PSC, is an agreement between a host country's government and an oil company or group of companies where the company gains the rights to explore, discover, and produce oil and gas from a specific area. The contract outlines how the produced resources are shared, with the company recovering its cost first and then sharing the remaining production with the government. And what are the key aspects of a production sharing contract? Rights granted to the oil company, cost recovery, production sharing, contract duration, work commitments. Now, under rights granted to the oil company, we have that the PSC grants the oil company the right to explore, discover, and produce oil and gas within a defined area. Next is cost recovery. The oil and gas company is allowed to recover its exploration and production costs before sharing any production with the government of the host country. In production and sharing, it means that after recovering its costs, the oil company and the government share the remaining production in a predetermined manner as outlined in the production sharing contract. In contract duration, the production sharing contract typically has a defined duration, including an exploration period, a development period, and potential extension periods, because they can't be there forever. Now, in the work commitments, we have that the PSC, which is the production sharing contract, should include specific work commitments such as drilling obligations, seismic data acquisition, and other exploration activities. Now, let us move on to joint venture accounting. Joint venture accounting in the oil and gas industry involves managing the financial aspect of partnerships where multiple companies collaborate on a project, sharing risks and rewards. This includes understanding different joint venture structures, accounting methods like equity and cost method, and managing operational measures and financial reporting within the partnership. And these are the key aspects of joint venture accounting in oil and gas: understanding the joint venture structures, accounting methods, operational measures and states, financial reporting, IFRS standards, cost allocation, risk management, and taxation and reporting. So, under understanding the joint venture structures, different joint venture structures such as cost sharing or joint ownership have varying accounting implications. For accounting methods, the equity method and the cost method are common ways to account for investments in JVs, with the equity method being more common for oil and gas. Now, when it comes to operational measures and states, joint ventures require managing operational data like costs, revenues, and production, which can be used for analysis and cost allocation. When it comes to financial reporting, proper financial reporting is crucial for understanding the performance of the joint venture and reporting to shareholders. Then IFRS standards. IFRS, which is the International Financial Reporting Standard, have guidelines that are essential for consistent and transparent financial reporting in the oil and gas industry. Cost collation or cost allocation. Joint costs need to be allocated appropriately among partners in a joint venture, and the tools and techniques to do this correctly are important. Risk management. Understanding the risks associated with joint venture is crucial for effective financial planning and risk management. And then finally, taxation and reporting. Joint ventures also have tax implications and require proper reporting to relevant authorities. And someone here might be asking, what are the benefits of joint ventures? Or what are the benefits of proper joint venture accounting? Number one, we have reduced risk. Number two, we have increased efficiency. Number three, we have improved decision making. Number four, we have enhanced transparency. In terms of reduced risk, by sharing costs and risks, joint ventures can help companies de-risk their investments. In terms of increased efficiency, collaborating on projects can lead to more efficient use of resources and capital. In terms of improved decision making, accurate financial reporting and analysis enable better decision making. And in terms of enhanced transparency, proper accounting practices ensure transparency and accountability within a joint venture. So why? Why do oil and gas companies participate in joint venture agreements? The truth is, energy exploration is a hazardous venture, and major oil and gas companies participate in joint ventures agreements so that they can spread risk. That's the major reason. Participating in joint ventures can reduce exploration risks, increase de-risking and commercialization, and accelerate capital efficiency. Thank you very much for listening. In the next course, or in the next lesson, we will be learning about asset retirement obligations. Thank you once again, and bye bye for now.